Much. Good afternoon, everyone. It is indeed my privilege and great honor to welcome all of you to this investors' earnings call to discuss the financial and operating performance of for the quarter.
Excuse me, sir, I'm so sorry to interrupt. There's a network.
Thank you for reminding us as we update you on our financial highlights for the quarter ended December 2021. I believe you must have gone through the press release and investor presentation available on our website as well as the websites of the exchanges. I will begin with an update on our economy, moving on to the mutual fund industry, and then to the performance of UTI AMC. Just as the company and the business were coming to the normal, another variant of corona, Omicron, emerged. While this variant seems to be less aggressive in terms of its impact, it is spreading faster than Delta variant, with almost all states now witnessing multiple times growth in daily cases. We remain optimistic that this new variant wave will definitely recede faster than it emerged following rapid progress in vaccination. We all know that we have created history by administering 1.65 billion doses of vaccine related to the corona. Let me share with you about our Indian economy. As the world steps into the new year, the path of the recovery in India as well as in the rest of the global economy encountered headwinds from a rapid surge in Omicron. Nonetheless, amidst upbeat consumer and business confidence and an uptick in bank credit, aggregate demand conditions stayed resilient. RBI's forecast indicated that our GDP was grown at 6.6% during the October-December quarter and at 6% in January to March 2022. The World Bank has retained its growth projection for India in 21-22 at 8.3%. We all are eagerly looking forward to hear from our Honorable Finance Minister about the budget of our country. Indian capital market. During the quarter, the benchmark indices had a roller coaster ride. While the October saw the indices hit new high, the December saw indices correcting as selling pressure across large cap, mid cap, and small cap intensified. The Sensex and Nifty fell by 1.5% during the quarter ended December 2021. As all of you know, as of January 28, 2022, and it means yesterday, the Sensex closed at 57,200 points, while Nifty closed at 17,102 points. For the calendar year, Sensex rose by 22% and Nifty climbed up by 24%. If we compare with the previous number, December 2020. Let me share with you about the Indian mutual fund industry. The quarterly average AUM for the Indian mutual fund industry stood at rupees 38.21 lakh crore as on 31st December 2021, growing by 5.5% during the quarter and by 28.6% on year-on-year basis. The closing AUM of the mutual fund industry as on 31st December 2021 was rupees 37.73 lakh crore, registering a growth of 2.7% over the previous quarter. And on year-on-year basis, the growth was at the rate of 21.6%. The total number of folios for the industry as on 31st December 2021 stood at 12.02 crore, registering an increase of 7.6% in the quarter and 27.5% from 31st December 2020 number. Friends, for the first time in the financial year, the SIP inflow crossed rupees 11,000 crore mark in November 2021 and continued with the momentum in December 2021, taking the SIP AUM to rupees 5.65 lakh crore, an increase of 3.75% over the last quarter from rupees 5.45 lakh crore as of September 30th, 2021. The SIP number stood at 15% of the overall mutual fund industry AUM. The total number of SIP accounts as of 31st December 2021 was 4.91 crores. During the quarter, equity-oriented schemes saw net inflow of rupees 1,02,041 crores, while debt-oriented schemes witnessed net outflow of 21,951 crores. Let me share with you about UTI mutual fund. For the UTI mutual fund, the total asset under management, it means our group AUM, we registered a growth of 3.87 over the last quarter and 19.43% over the previous year. And our group AUM stood at rupees 13.11 lakh crore as of 31st December 2021, as against 12.63 lakh crore as on 30th September 2021. And our group AUM as of 31st December 2020 was 10.98 lakh crore. So from the base number of 10.98 lakh crore in December 2020, we grew to 13.11 lakh crore as on December 2021. The quarterly average AUM of the mutual fund scheme for the quarter ended December 2021 was rupees 2.25 lakh crore as against 2.09 lakh crore for the quarter ended September 21 and rupees 1.65 lakh crore as of December 2020. The quarterly average AUM grew by 7.5% over the last quarter and witnessed a year-on-year growth of 35.9%. UTI MF quarterly average AUM market share stood at 5.88% of the mutual fund quarterly average AUM, an increase of 10 bps from September 2021 number. The equity quarterly average AUM as of 31st December 2021 stood at 70,085 crore, an increase of 60.5% over rupees 43,677 crore as on 31st December 2020. The market share for equity AUM stood at 5.29% for UTI mutual fund. The quarterly average AUM for index and ETF recorded a growth of 71.4% from rupees 35,199 crore as of 31st December 2020 to rupees 60,341 crore as of 31st December 2021. In the October-December quarter, UTI added 2.06 lakh folios. In the past 1 year, UTI has added over 7.01 lakh folios, taking up the number of live folios from 1.09 crore as of 31st December 2020 to over 1.16 crore as of 31st December 2021. During the past 1 year, the open-ended equity scheme added 7.55 lakh folios. Friends, UTI was able to capture 8% market share of the gross sales of the industry during the quarter just ended. Our ETF and index fund saw net inflows of rupees 3,379 crore during the December quarter, constituting around 8.3% of the industry net inflow, while the equity fund net inflow for the period was 2,135 crore, being 5.2% of the industry net inflow. The SIP inflow for the quarter 3 stood at 1,352 crore, rising by 13.10% over the previous quarter and by 65% from the corresponding quarter last year. The number of SIP accounts rose by 53.1% since December 2020, and with over 20.01 lakh SIP folios as of December 2021. UTI's SIP AUM for the quarter stood at rupees 18,126 crores, an increase of 4.2% as compared to September 2021, which was at rupees 17,389 crores. Keeping up with our commitment to deeper and better access to these 30 cities, 23.8% of our monthly average AUM for December 2021 was contributed by beyond 30 cities, whereas the industry stood at 17% in terms of its B30 monthly average AUM. 108 out of our 167 UFCs are in the B30 cities. We have and we will continue to build a world-class investment organization, and in the process, we are adding the professionals. During this quarter, we brought in Mr. Anurag Mittal, and he is our Deputy Head of Fixed Income. He has a vast experience, very rich experience, and I am confident with the addition of Anurag, UTI's fixed income investment team will indeed add value to investors. Friends, let me share with you about our subsidiaries, and first among them is UTI International. The average AUM of UTI International has increased by 59% from rupees 21,720 crore as of 31st December 2020 to rupees 34,608 crore as of 31st December 2021. Our international clients are spread across 37 countries. These are primarily institutions, pension funds, insurance, banks, and asset managers. One of our flagship funds, the India Dynamic Equity Fund, has an average AUM of USD 1.4 billion and is being widely recognized internationally. During this quarter, under consideration, UTI International has launched an Indian government bond ETF, UTI India Sovereign Bond ETF, which is listed on the Amsterdam Stock Exchange. The fund tracks the performance of Nifty India Select 7 government bond indices, which comprises of top 7 most liquid local currency sovereign bonds issued by the central government of India. UTI Retirement Solutions. UTI Retirement Solutions Limited has been managing the NPS corpus for the government and non-government sector. As of 31st December 2021, its AUM is rupees 1,93,331 crores and has a share of 27.65% of industry AUM. UTI Capital. UTI Capital, with an AUM of rupees 1,056 crores, currently manages active debt funds like UTI Structured Debt Opportunity Fund, which was launched in August 2017 and closed in May 2019, having AUM of rupees 301 crore. And UTI SDOF 2, which was launched in September 22, having AUM of rupees 469 crore, and the fund is currently in fund-raising stage as well as investing. Let me share with you about the UTI financials. UTI AMC's financials improved on the back of strong net flows and cost control measures taken. During the third quarter, the company posted a consolidated net profit of rupees 127 crore and consolidated core net profit of rupees 91 crore as against 36 crore in the corresponding period of last year, reflecting a growth of 153%. The operating profit margin as a percentage of AUM for the December financial year 2022 quarter was 16 basis as against 11 basis for quarter 3 of financial year 2021. along with improvement in our operating profit margin. ROE of the company on a consolidated basis is 19% in the 9-month period ended 31st December 2021. The PAT margin stands at 46% for the 9-month period ended on 31st December 2021. The net worth of the company on a consolidated basis is rupees 3,539 crore as of December 2021. With this, I wish each and every one of you a very happy Vasant Panchami. I have with me my distinguished colleague, Mr. Surajit Saha, CFO of the company, Mr. Vinay Lakhotia, Head of Operations, and Mr. Sandeep Tamsi, Head of Investor Relationship. We are ready now to take questions. Thank you once again for joining this call. Over to you. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star then one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Yeah, good afternoon, everyone. Thanks for taking my question, sir. So my first question is around the yield. We have seen a very sharp decline in our equity yields on a sequential basis. So I know that this has been a industry-wide trend, but for us, it seems to be much more pronounced in terms of decline. So if you could throw some color, what has caused such a steep decline on the equity side? And the second question was around our admin expenses have also shot up in this quarter. So what could be the quarterly or the annual run rate which we should keep in mind? And just a clarification, whether these other expenses include the pass on which we do on the PFRDA income which we receive, that is 1.5 basis points which we need to pass on. So if you could clarify on that front, and any development on the employee cost side, are there any plans to reduce this cost in the near term? How are we thinking about that? Those would be my questions.
Yeah. Good afternoon, sir. I'll take the call on the yield, and I'll request Surajit to clarify on the cost part. Yeah, you are aware. Yes, you are correct. The yield has dropped actually, and if you remember in the previous phone call as well, we have given a guidance that the revenue yield will fall by 2 or 3 basis points, primarily because the inflows that are coming into the equity and balance fund, the fresh inflows is effectively at a lower yield as compared to the yield that we are running on the stock AUM. While on the stock AUM, the yield is closer to around 90 basis points, but the yield on the fresh inflows is at significantly lower yield. So because of that, there has been some drag on the yield, not only on the equity fund, but also on the overall basis. So also on the overall basis, if you see the yield has actually fallen by around 3 basis points from 44 to around 41 basis points. And apart from a drop in the equity yield, another important factor has been the growth in the ETF and the index fund, which has grown at a significant pace on a year-on-year basis. So while our total AUM growth has been 35.9% and the equity AUM growth during the same period on a quarter-on-quarter basis has been roughly around 50%, ETF AUM has grown during the same period by almost around 72%. So as you are all aware that the ETF AUM, the management fee that we charge is in the range of around 5 to 6 basis points. So that kind of actually has dragged down the overall yield by a basis point or two, because the ETF AUM as a composition of overall AUM has actually increased by 600 basis points year-on-year basis. Because of that, the overall yield has dropped down. But having said that, we are confident that for the entire financial year, we'll be closing at a revenue yield of close to around 41 to 42 basis points. But having said that, as we have indicated in the earlier call, there has been a significant reduction as far as the cost yield or the cost margin are concerned. Hence, our PAT yield has been maintained at the same level of around 21 to 22 basis points, and we see no dilution as far as the PAT yield is concerned. And definitely because of the growth in the AUM and the incremental fees, we are confident that the PAT margin number will actually be improving going forward, because whatever the incremental revenue that we get will add to our PAT margin number. So yes, as indicated in the earlier call, there has been a slight drop in the revenue yield, but because of the cost reduction initiative, as well as because of operating leverage playing its part, the cost yield has come down drastically, and the PAT yield we are able to maintain at the same level. On the cost part, I think I'll ask Surajit to comment.
Yeah. On the cost part, I think you have, in the question itself, you have the answer. So the difference between, for the 9-month period, if you see, it was 92 crore, it has come to 147 crore. This difference of 55 crore is pertaining to one-time expenses which we discussed in September also. That is the brokerage expenses which we need to pay for the PLI and RPLI, which is around 8 crore. 14 crore is the trail fees which international has to pay in respect of the business in tandem with the revenue increase which has happened in UTI International. And 15 crore, yes, PFRDA fees, that is the 1.5% fees which we give it to the PFRDA. And the last difference, as you know, is regarding the digital initiatives which we have taken in respect of the Bloomberg and other expenses. So these are the four pillars on which our expenses have increased, out of which this 8 crore expenses regarding the PLI and RPLI is a one-time expenses. And in respect of the employee cost, as you said rightly, in our earlier call also we have said the retirement benefit which will be coming, it will be spreading over to the next 3-4 years. But definitely you have seen that there is a decline as a percentage of the cost from 22 bips to 17 bips on a quarterly average AUM. The employee cost is on a decline. So definitely all steps management is taking to keep the cost under control in respect of employee cost.
Got it, sir. So if you could, help us understand that going forward, what sort of yield decline should we expect? Because this quarter seems comes as a negative surprise in terms of a very sharp decline, because my calculations suggest that on the equity side itself, there has been some 8 to 10 basis points of decline in the yield. So going forward also, for the next quarter and for the next 6 to 8 quarters, we could expect such continued compression in yields.
So, Sayesh, for the March quarter, we are maintaining a guidance of around 41 to 42 basis points only. That we can give a guidance on the overall weighted average, the yield will be closer to around 41 to 2 basis points.
And for the next 5 to 6 quarters, could we expect such a trend?
Yeah, there will be a decline definitely as far as the revenue yield is concerned, at least by a 2 or 3 basis point in a year. But we are confident that as far as the cost structure is concerned, since we have a declining cost structure and because of operating leverage, the cost yield will actually come down. So we don't see any dilution as far as the PAT yield is concerned. So yes, revenue yield may compress by 2 or 3 basis points in next financial year, but we should be able to maintain our PAT yield.
Got it. And if I could squeeze in one last question, are there any one-offs in other income, because that has seen a very sharp drop? So if you could clarify on that front as well.
As you know, because of the industry for the last quarter, the yield has increased from 6 to 6.65, as well as the market as Nifty has come down by 150 points. It's mainly because of the M2M gain, nothing else.
Got it. Thanks for the answer, sir, and all the best.
Thank you. The next question is from the line of Priyesh Jain from Motilal Oswal AMC. Please go ahead.
Yeah, good afternoon, sir. So just extending the point on the yield part, you're saying that the yield will drop by around 2 to 3 basis points even in next year. So is it that the incremental AUM on the equity side is coming at possibly we're talking about the yield much almost half of what we are doing on the newer on the older assets. And secondly, so what is this? Is this from the NFO's point of view, or the yields are also so compressed on the existing schemes as well? So what is the impact between the NFOs as well as the cut in yields on the existing schemes? That is my first question.
So yeah, the yield on the fresh inflows are definitely lower as compared on the stock AUM. While on the stock AUM, the yields are close to around 90 basis points. The yield on the fresh AUM varies depending on the category of the scheme as well as the distributor category from which we are actually mobilizing it. So in the earlier phone call also, we have given a management guidance that the yield vary depending on the sharing ratios, and our sharing ratio is around 50 to 80% of the total expense ratios between the manufacturer as well as the distributor. 50% being the lower end of the distributor category, which is the IFAs, and 80% will be your the banks and the national distributor. So definitely the yields on the fresh inflows is lower as compared to a stock AUM. We don't see much of a difference in the yield as far as the NFO is concerned. The NFO margins are also in the similar range. We did have an NFO in our equity scheme in the second quarter, where we mobilized close to around 2,500 crore in focus equity fund. That has also attributed to a slight drop in the equity yield in this particular quarter. But yes, the trend will be there. We do see impact of around 2 to 3 basis points in the next financial year as far as the revenue yield is concerned. But having stated that, we are confident of actually maintaining the PAT is concerned, and PAT margin number should actually improve going forward, because whatever revenue is getting added is being earned, is being added to our bottom line, and the PAT margin number will be actually be improving it.
That's helpful. Secondly, on the international funds, can you just international subsidiaries, can you just give some light as to what are the kind of flows that we would have seen in the 9-month period, and what will be the impact of NPM on the AUM between flow and the NPM?
Yeah, the flow you can always, in the investor presentation also we have given that the AUM has increased year on year 59%. And if you see the international business yield, which was 26 bips in Q3 21, has come up to 35 bips in Q3 FY22. That is as of December 21. And September it was 32 bips. So continuously the overall improvement in the yield in the international business is helping us to give a good contribution to the overall PAT.
So my question is on the flows. As to what is the kind of flows we've seen in the international subsidiary in the 9 months?
Yeah, 9 months, if you see from 59%, that is from 36,400 is the current AUM, and it was around 21,000. So overall there is a flow of around 12,000. Out of that, 1,100 is the appreciation value, and the rest is the equity flow which has come in the international business. Okay.
And what are the strategies with regards to future product launches, both on domestic side as well as international side? So the domestic particularly, whether we are going towards, when we will be launching ETFs, would we be focusing on slightly higher yield products like smart beta ETFs or something of that sort? So what's the product launch pipeline, and both domestic and internationally, and what are the thoughts behind launching this product?
On the domestic side, we have an approval from SEBI for a multi-asset fund, multi-cap fund, but we are waiting for the right opportune time for launching it. We also have approval for 2 smart beta funds. One is a mid-cap fund and one is a low volatility fund. But these will again be soft launches because, these are funds which grow over a period of time. People have to get used to the concept. So we expect the AUM to grow over a period of time. We will not be, these are not mass market products. So our multi-cap fund is one which will be a larger base, which will be a more a mass market product that we'll be launching. On the international funds, I would request Surojit.
Innovation fund.
Yeah. So we are also on the international market. We are looking to launch a global innovation fund, which will be looking at the new age companies which are coming up in India, and we are doing the initial understanding from our investors across the globe on whether they would have some kind of interest in this kind of a fund. So this is in the pipeline. This will take some more time. We have not finalized the contours of the fund, but this is something that we'll look to launch on the international side.
Just to add, on the domestic side, because of the heavy categorization, apart from the multi-cap category, we don't have any other product gaps available. So apart from the multi-cap, most of the product launches in terms of NFO will be either an index fund or an ETF category kind of fund only. So multi-cap is the only category that is available. Rest all products, whenever we launch, it will be either an ETF or an index category fund.
Yeah. So just on that ETF and the index category fund, what will be the thought process? You mentioned that the yields on this asset are around 5 to 6 basis points. And while some of the ETFs can fetch higher TERs as well as higher income for the AMC, do we move towards those kind of products, or we will try and get some market share with trying to maintain these kind of yields? So my question is also to understand whether the yields on the ETFs can improve going ahead, or we should work with these numbers at 5 to 6 basis points.
Yes, most of the ETFs that we will be going to launch going forward will be a smart beta kind of a product, where the expense ratios both on the ETF as well as the index categories will be significantly higher than what we are charging it. So why our AMC fees on the ETF category currently 5 to 6 basis points? Because of the two major Nifty ETF funds, which is a major contributor. There we charge an expense ratio of close to 7 basis points. But the new launches, like we launch a momentum index fund, and going forward, whatever the smart beta product that we are going to launch, we see an AMC yield of close to around 35 to 40 basis points, which should actually improve the ETF and the index category AMC fees going forward. So it all depends on what the contribution of those, the ETF and index category to the overall AUM, but definitely it will be significantly higher as compared to 5 or 6 basis points that we are currently charging.
So Prayesh, to look at your question, there are two strategies. One is the investor who's looking at a evolved product to invest in, and these are some of these index funds, ETF funds are for those kind of investors who want a smart beta strategy to invest. So we are getting to two different markets. As when I said that anyway the yields are going to be higher, but we have to look at different sets of market and launch products for them. So the multi-cap fund will be for the more retail investor who's looking to invest in the broad market, while some of these smart beta funds will be towards the evolved investors. So there are two separate segments that we are looking to target.
All right. Thank you so much for all those detailed answers. Thank you so much.
Thank you. Before we take the next question, a reminder to the participants, please limit your question to 2 per participant. You may rejoin the question queue if you have a follow-up. The next question is from the line of Madhukar Ladha from Elara Capital. Please go ahead.
Hi, thank you for taking my questions. First, what percentage of the current AUM is like the old book, which was the low sort of trail commission book? Second is, the employee costs. What has been the progress in terms of, the number of retirements, and because somehow the costs are still high. So I know that this should sort of trend downwards, but it still seems to be a little bit on the higher side. So when do we see that sort of flowing into the numbers? That's my second question. And third, can you give me the number for support service fees on interbranch billing for the last two quarters, for this quarter and the last quarter?
Madhukar, on the first question, the yield on the stock OEM, we are disclosing it, but really we don't have a breakup of what is the total component of these no trail commissions AUM on the overall. But transparently, we have been disclosing the net sales number on every quarter-on-quarter basis. So definitely you can derive some of these numbers as what the fresh AUM is there of our total AUM. So net sales number we have been disclosing every quarter on the
Right.
employee cost, like Pahad said.
Yeah, employee cost, I told you regarding we have plans, but it will take some time because of the current pandemic scenario. We have no plans which we have decided earlier, but we are it is on the cards and we'll look into it. And the normal retirement, as you are aware, it will every year the impact will be coming, and maybe slowly it will be you will be seeing the impact in the employee cost over the years till 2028.
Right. And the support service fees?
Yeah, interbranch billing, as last time we said, we are not showing in our accounts now. Like offline, if you can talk to me, I can give you the figure. But now interbranch billing is not part of our accounts. We have removed it, if you remember, in the last quarter itself.
So Madhukar, as you are already aware, it's just a contra entry. So there is no point in showing one figure in income and another in expenses.
So it's been netted off. So that
Yeah.
so it's
Yeah. That's why in the last presentation in September, we made it very clear that we are not showing it in our books from September 21. So December, it's not appearing at all.
Right.
Madhukar, Imtiaz here. On your employee cost, we are achieving our goals so far as the natural attritions are concerned by way of the retirement, and it is a very significant number. If you see the employee cost, it has not increased despite the fact that, as you know, there is serious pressure on attritions of the good asset, good employees. So we have not increased the employee cost. Now going forward, what is our strategy? So we will let you know if any specific strategy comes out. We are working to increase the efficiency of the employees. We are working to enhance the skill of the employees. Proper skilling is also happening, but rationalization of the employee will also happen. And for that, we need to wait. It needs a lot of other factors to be considered. Madhukar?
All right, sir. All right, sir. All the best, sir.
Thank you.
Thank you. The next question is from the line of Jignesh Sahai from InCred Capital. Please go ahead.
Yeah, hi. And thanks for the opportunity. Firstly, just to clear the confusion between console and standalone. So your standalone number is only for the mutual fund, whereas your console will have all these businesses together. Is my understanding correct?
Yes.
Yeah, okay, perfect. Now, secondly, you said that incremental funds, only multi-cap funds will have under the equity, whereas the rest will be under index category, whereas even in the index category, the yield will see an improvement. Is my understanding correct on this, whatever you said?
Yeah.
So all your multi-cap will get into...
Most of the fund that we plan to launch on the ETF and the index category will be a kind of a smart beta product where the yield will be significantly higher as compared to our stock AUM yield.
Okay, understood. But still you are saying that incrementally over a year, you will see your revenues will be seeing the 2 to 3 bits kind of a decline. And that basically is because you are shifting from trail to, the entire is shifting towards trail commission basis. Is it the reason or there is something else to it?
So it's a combination of two factors. That the fresh inflows that is coming it as a lower yield. Plus we have to see the growth of ETF category as well, because that is going at a substantial pace. So the growth of ETF category kind of drags our overall yield put together. So even if in last 1 year, if you say, ETF category has actually grown by almost around 600 basis points in our overall asset composition. So because of the 5 and 6 basis points we are charging under the ETF category, it kind of dragged our overall yield number. So just there will be a marginal decline in the revenue yield, but PAT yield we are confident in the same number.
Understood. And this incremental yield which you are saying is coming at a low, when incremental funds coming at a lower yield, that is basically because of the competition which is getting built up, or the brokerage which has been paid is relatively higher. Any particular reason why this incremental is relatively low? Yields are low?
Yeah, it's actually a competitive industry, and brokerage rates are almost standardized across all industry players. As we have stated earlier also, the sharing between the distributor and the manufacturer is in the range of around 50 to 80% of our total expense ratio. So definitely the fresh money that is coming, it has a lower yield as compared to the AUM yield that we are charging on the stock AUM.
Okay. And just last thing, I see this a sharp dip in UTI capital AUM from June to September, whereas UTI International I'm seeing a sharp rise. Anything to read about, because I'm a little unaware about this. Any specific reason behind it?
Yes, here I see UTI Capital is basically we are in the building stage. So we had a fund, a job fund, and we have basically paid back to the investors. Very successful fund. So we are in the process of launching the fund 2, job 2. We have already launched. So we are on the fundraising stage now. We have built a very strong team. We have built a very good track record, and this is a building stage. So we are building this particular company, and we need to wait for a couple of more years to start this company delivering good contributions to the parent company. You see that UTI International is now doing a terrific job, and UTI Retirement Solutions is also doing a terrific job. So, and our fund, is doing pretty well so far as UTI Capital is concerned.
Understood. Thanks for this and all this. Thank you, sir. Thank you very much.
Thank you. The next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Thank you. On one data point, if you could, a few data points on the period and AUM by segment, which you usually give on the call. Could you share those numbers, please?
Aditya, you want the AUM for which period? For December? You want by the category?
Yeah, the period end. You shared the quarterly average.
So you want
period end.
For UTI?
Period end for December by segment. So equity, hybrid, debt, liquid, passive.
Yeah, so the total AUM is 2,16,382 crore. Equity 71,022 crore. Hybrid 26,773 crore. ETF and index fund is at 61,264 crore. Income at 19,041 crore. And liquid fund at 32,282 crore. So overall AUM 2,16,382 crore.
Got it. Thank you. And then, in response to an earlier question, you mentioned that benefits from retirals will come gradually till 2028. So just wanted to check. So historically, our guidance has been 60 to 70 crores of benefits from retirals coming over 3 to 4 years. Are we changing that? Was the comment in a different intent?
No, I think that's the guidance that we are giving, that 65 to 70 crore will be the saving over a period of next 3 to 4 years.
Got it. Okay. So that's maintained. And just if you could discuss how you look the OPEX side of, so you've discussed the yield impact of ETFs and smart beta ETFs. The OPEX side, how do you compare the passive versus active? That way I understand passive would be much lower. But is there some rough sense you could give us how much does it take to run the passive side versus active side?
So I'll give you the expense ratio on the ETF category, which is the Nifty ETF, which is the largest, is close to around 7 to 8 basis points, and AMT yield that we are charging is 5 basis points. So to run the operation, it's hardly less than 2 to 3 basis points of OPEX on the ETF category concerned.
Got it. So that's on the scheme, and on for the AMC P&L, there is no implication of that.
The entire team is in place. We do have a team in place, and there is no incremental cost as far as AMC is concerned, even if we launch additional passive or the ETF categories of funds.
Right. No, sir, I wanted to understand, so the way the things stand now, I understand incrementally, there is operating leverage both on passive and active. But if you look at the cost structure today, how much of it would you, if it's possible, to allocate to passive within the other OpEx and within the staff cost?
On the AMC side?
In the operating expenses on AMC P&L, in the employee benefit and other expenses, is there a way to allocate, break this apart into how much is towards passive and how much is towards active?
Even if we don't have the number as of now readily available, but just to give a number perspective, it's hardly a team size of around 5 people on the passive side. So their salary cost and maybe some bit of infrastructure related cost. So it will be a very, very minuscule number as compared to the overall OpEx number at UTI AMC.
Got it. That really helps. Thank you. Thanks a lot.
Thank you. The next question is from the line of Anshuman from ICICI Securities. Please go ahead.
Yeah, good afternoon, sir, and thanks for the opportunity. I just wanted to one clarification. You mentioned about your PAT basis point of your expectation of maintaining it at 20 to 21 basis point. Is that number correct? And this includes the other income, all inclusive of that number, right?
Yeah. This is inclusive of all the numbers. The PAT at a standalone basis, not on the console number.
Okay. On a standalone basis, you have a fair visibility that it would remain around 20-21 basis points,
yes,
despite the volatility of the yields.
Yeah, because we are confident that with the cost structure, declining cost structure, and the cost yield coming down because of operating leverage, I think we should be able to maintain our PAT yield.
But your other income could be very volatile, right? So what kind of other income we can kind of think in this number?
No, see, other income will definitely be volatile, but we have certain investments in venture funds which, whenever it exits, it doesn't depend on so much on the certainly index. So those things we have on the cards, we have investments, so that will be contributing to the other income.
Right.
Anshuman, we have also, in our presentation, investor presentation, we have shown the core PAT. Yes. And we also shown displayed and highlighted the overall PAT. So that will give you a clear visibility how the number would look like.
Right. Got it, sir. And my last question is, in a couple of quarters back, I think Q1 at time of Q1, we were thinking of more of 43 basis points for this year, whereas now it is more of, let's say, around 40-41. So this surprise is mostly because of a higher amount of ETF inflow or a combination of all the constituents?
So for the full financial year, we are confident of maintaining it around 42 basis points. It's a combination of two factors, the growth of ETF as well as the contribution of the fresh inflows being at a lower margin as compared to the stock AUM. So we have indicated in our earlier call as well that there will be a marginal decline, and we are confident of maintaining it at 42 basis points.
Got it, sir. Thank you. That will be all.
Thank you. The next question is from the line of Shubhranshu Mishra from Systematic Shares. Please go ahead.
Hi, sir. Thank you for the opportunity. Couple of questions. One is that we've got a lot of seasoning in our equity scheme, sir, yet the bank's contribution to our equity AUM is around, anywhere between 9 to 11%. Also, it's slightly puzzling because we have got three large banks as our stakeholders, which is SBI, PNB, and Bob. So just wanted to understand this, and also if you can give out the concentration of maybe the top 500 or top 1,000 MFDs to the equity contribution, from the 61,000? That's the first part of the question. So second part is that in our liquid and overnight funds, what's the split between PSU companies and private sector companies?
So let me just say this about the last questions. We are not getting much money from the PSUs as we are the private company. So we are like ONGC and all, they don't invest with us now. And now there are other questions about the free shareholders and what is the contribution. We are getting a significant amount of contribution from BOB and PNB, and we are working with the State Bank of India to increase their allocations out of their distribution of wealth arm. And other details of FFC's calculation top 500, Sandeep will share with you. Sandeep?
Yeah. So, Subhranshu, if you look at the banks also, as Mr. Rahman sir shared, we are getting a good share from the bank. So if you look at my AEM, which is, as of March, it was around 1.56% of the AEM was coming from the banks. Now it has improved to 2.11%. So there is an improvement on the equity side in the contribution which is coming from the bank. If I look at the national distributors, which are the larger distributors, again, if I look at my March 21 numbers, they were about 1.23%. This has improved to 1.52%. So we are seeing improvement in the top distributors as well as banks sharing, or participating in the growth of UTI and selling our funds.
My question remains unanswered. What is the concentration of top 500 MFDs in the equities from the 61,000 MFDs?
We don't have number. We can share it separately. As of now, we don't have that number in the AEM.
Sure. Thank you.
Thank you. The next question is from the line of Viraj from Securities Investment Management. Please go ahead.
Hi, thanks for the opportunity. I just have 3-4 product questions. First is, your commentary that despite the fall in yield, we will see an improvement in PAT margins, even in FY23. Now, I just have 2 parts to the question to this. First is, if I look at your yield across major products and even in ETF, your yield which you charge is significantly lower than what the other competitors in the market are charging, and even lower than what the prescribed maximum limit is. So just trying to understand with this and also the fact that we are being more aggressive in the marketplace, what is the thinking, behind this particular strategy? So that is one. Second is, if I look at your commentary of PAT margin improvement, the cost part, is that linked to the growth in AUM, or we think internally we have levers to further reduce the cost on an absolute basis? Just trying to pick your thinking on that. So that is first on the overall yield part. Second is on the market share part. If I look at your overall liquid product market share, or even hybrid, or even for that matter NPS, we've been seeing a market share erosion for last 2-3 quarters. So just want to understand what is driving this, and where do we think this will settle at? So that is second. And third is on broadly at the company level, if any particular large investor chooses to exit stake at the agency level, does that necessitate a change in that particular investor's shareholding at the sponsor level, or those two are mutually exclusive? Thank you.
So I'll take the first part of the question. As far as our expense ratios and the yields are concerned, to the best of my knowledge, I think our AMP, the yield on the stock AUM is not higher, as definitely at par with some of those listed players. So virtually we are making close to around 85 to 90 basis point of yield on our equity and hybrid category of the fund. And the expense ratios we are charging are in line with SEBI regulation. So whatever the SEBI regulation permits, we are charging the expense ratios. On the lever, on the cost part, yes, we have some lever on the cost part where we believe that our cost structure going forward will be actually on a declining trajectory, and that is being demonstrated in our cost ratios over the last 2 to 3 years. major part of that saving will be on the employee cost, where because of retirement, the employee cost will be actually on a declining trajectory, and we may not see a significant increase in an employee cost over a period of next 2 to 3 years, primarily because of the retirement that is taking place. So yes, the cost trajectory will be on a declining trajectory, and because of operating leverage and on account of growth in AUM, the cost ratios will actually improve, and it has been actually improving over the last 2 to 3 quarters. So that's why we are confident that in spite of a drop of 1 or 2 basis points in the revenue margin yield, we should be able to maintain our PAT yield.
So just, sorry to interrupt, on the yield part, if you look at the ETF product, as you said just now, we charge 6 to 7 basis points. Now, comparable products from other AMCs, they charge somewhere between, say, 15 to 20 basis points. The net yield after expenses for them is around 10 to 20 basis points on the minimum. But for us, it's hardly 2, 3 basis points. So that's what I was driving, what is driving this aggressive fee structure. And on the top of that, we have a very aggressive sharing with the channel as well. So just trying to understand our overall strategy in terms of product pricing, in the marketplace. That is one. And second, on the cost, what I really meant is, in absolute basis, do we have any levers to further bring it down? Because I understand AUM growth is also a function of what the market appreciation plays out, which is not really in our hands. But if I have to understand in absolute level, either employee costs or other OPEX and admin, do we have any levers to further bring it down, irrespective of the AUM growth?
On the ETF categories, our expense ratios of 7 basis points is in line with the other market leader in ETF, which is SBI Mutual Fund, because that's the kind of expense ratios we work with EPFO. So in spite of charging close to around 7 basis points of our TER, our yield on the AMT yield on the ETF category for the Nifty ETF fund is close to around 5 basis points, and that's more because of our arrangement with EPFO, which we and SBI Mutual Fund follow. In some of the newer ETF and the index category, especially like your momentum index fund or a smart beta fund, we are confident that the yield will be significantly higher as compared to what we are charging on the Nifty ETF fund. But definitely those AUM as compared to the overall AUM will still be a significantly lower. So you might not see a marginal increase in the overall yield category of the ETF and the index fund category. On the cost part, as we have indicated earlier, because of the retirement of the employees, we see a significant drop in the employee cost over a period of next 2 to 3 years. So the cost will be actually on a declining trajectory, and apart from the operating leverage, we don't see a major rise in the employee cost over the next 2 to 3 years. The management has given a guidance earlier that we see a cumulative saving on the employee cost because of retirement to the extent of around 65 to 70 crore over a period of next 2 to 3 years. So once you factor that into our projections, our employee cost actually is on a declining trajectory, and that gives us the confidence that the ratio will actually be improving going forward.
On the market share and on the shareholding, if you can comment on that.
Yeah. So if you look at my income category of funds, I have actually increased my market share from December 20 to December 21. It has grown up by about 10 basis points. But that is significant because, as we had mentioned earlier, that some of the impact of the credit crisis had impacted us. And now we are again, with the strengthening of the team, with the improvement in our fund performance, we are seeing traction coming back. So if you look at my AUM from September to December, it has actually grown. So we feel that this momentum will continue. Though on a year-on-year basis, my AUM has fallen because December 20 was a different scenario. Now again with the interest rate and all that, there is a different scenario. But we feel that the investors' confidence is coming back, which is seen from my increase in market share in the income category. If you look at my liquid category, this is again the quarter phenomena where the AUM flows are higher. We are seeing some AUM flow which has happened for us. And that is, because of the liquidity crunch that is there in the market, we saw that our AUM was redeemed, and we saw some fall in our market share in this category. But again, once the quarter is over, we are confident that we should be able to get back our flows in the liquid category of funds.
But overall, our market share has been improving, so there's a good sign. And what is your question on shareholding pattern?
No, my question also was on market share loss in NPS business. It used to be 30-31%. I mean, usually that's how it's always been, but last 9 months it's dropped to around 27 odd %.
Okay. In fact, let me answer that. In fact, if you see now the recent quarter, our allocation is 34%. For 3 months, almost 2.5, 3 months period, the allocation was reduced to 17%. It has been reinstated to 34%, and that is the reason overall market share shows a dip. But if you go fast forward, our allocation will be in the range of 33 to 34%.
And on the change in shareholding, so if any large investor were to exit the stake completely, does that also necessitate exit at the sponsor level?
We have no idea about that. I have no idea. As a CEO, I have no idea about any exit plan of any shareholders.
No. I'm just talking about a hypothetical thing. I'm not saying if anyone is exiting. Just hypothetically, if anyone were to exit.
I can't answer any hypothetical question. You know, this investors conference. I can't answer. I have no idea about any shareholder exiting. Right? As a CEO, I have no idea.
Okay. Just one last question, if I can squeeze in. On the international business, you said that the increase in AUM on a 9-month basis was somewhere around 12,000-13,000 crores, of which the appreciation was only 1,000 or 2,000 crores, and inflows was around 11,000 crores. But if you have to look at the overall market returns also, it seems the fund itself has underperformed considerably. I mean, am I missing something here? Just trying to understand,
that increase which has taken place includes equity as well as the debt fund, right?
Right.
And in the equity fund, the major fund is the IDEF fund, which is around 10,500 crores. So for that, the inflow itself for the 12 months was around 4,500 crores. And the appreciation in that is around 1,700. And the debt market, as the yield and all, it's not much appreciation is there. So that is why I said 1,700.
Okay, got it. Thank you very much, and wish you good luck.
Thank you.
Thank you. Ladies and gentlemen, we take the last question for today. It's from the line of Hiten Jain from Invesco Mutual Fund. Please go ahead.
Yeah, hi. I have 2 questions. First is, normally in third quarter, the data that we have for the last 2 years, there is an accounting of variable pay. And normally in third quarter, the employee cost goes up, at least in the last 2 years. But this quarter it hasn't been so. So is it that we have cut variable pay, and that is why employee cost is sequentially looking slightly down?
No, if you remember in the last December quarter, we said because we are expecting the market to move up, so we have provided 60 crore AUM, 60 crore variable pay for the full year. So as of December, 45 crore was charged. But this year we have taken a budget of 35 crores. Only 27 crore has been charged for the 3 quarters. So that difference is appearing in the employee cost.
So the variable pay is down from 45 to 35 crores in this financial year. Is that right?
45 to 27 for the 3. 60 crore was taken for the full year. So up to December it was 45 crore in the last year. So in this year, total amount is 35 crore. For this 3 months, it is 27 crore.
Understood. So net, if you think about your estimate of variable pay, that is 35 versus 45 last financial year, right?
Yeah. For the full financial year, we have paid out only 35 crore. In the last quarter, it got adjusted. But for the up to December, we charged 45. But end of the year, as of March, we paid out 35 crore only. Once our KRA and everything got finalized.
Correct. So net, you are saying there is no change in variable pay, neither increased nor reduced, right?
Yes.
Okay. And my second question is, isn't there a fixed retirement age, which is where, how does it work in your company? Is there a fixed retirement age, or it is subjective, you have to take board approval? Because on an earlier question, there was this statement made saying that because COVID was there, we are working with the board and we are working on the retirals. So isn't there a fixed retirement age?
Yeah, there is a fixed retirement age for all employees.
Okay. So then what was that response to? We are working with the board on retirement and given COVID is around. So what was the response, that in what context?
The response was somebody had asked the questions, are we planning any VRS?
Okay.
Yeah.
Okay. So on VRS. Okay. And this year, what I've seen is, at least in the last 3 quarters, there's this reduction of 48 employees. And if I'm correct, there is no retirement in this 48. It is just people have left and you have not replaced. Is that the right understanding?
Retirements are there.
Okay.
There will be normal attrition also at the junior level.
Okay. So out of this 48, how many people would have retired?
How many people have retired? I will send you the data.
Okay. All right. Thank you.
We will arrange to send it to you.
Thank you very much.
Okay. Thank you.
Ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for closing comments. Over to you all, sir. Ladies and gentlemen, with that we conclude today's conference call.